Hey, gang. Steven Sitkowski here once again. Welcome to this week's edition of Market Insights. It is President's Day, so the market is closed, but it doesn't mean we don't have a few things to talk about. Maybe not as much, but still some things that you ought to know about what's been going on for the last week. Hope all of you had a great week. It is February the 19th. Quick reminder that everything we do here is for informational and educational purposes only, not intended as investment advice. So what is moving the market? Well, the major indexes, they broke a 5-week winning streak. Yeah, nothing goes up forever. That's part of the deal. Part of the problem was that we got some hot inflation numbers. The PPI number, that is the producer price index, basically inflation at the wholesale level, went up 0.3% in January. They were hoping for 0.1, and the CPI came in at 3.1% year over year. The market was expecting 2.9%. So both of those were hotter than expected. So here's sort of the consequence. The consequence is that Wall Street starts to extrapolate, oh, well, then the Fed's not going to be able to cut interest rates as soon as we were hoping. And an interest rate cut would be good for the market. And you start to see things like the 10-year Treasury begin to creep up, and the market falls a bit. And it just overall becomes a bit less bullish. And that's what happened last week. 10-year, last time I was with you, this was around 4.1. Now it's 4.281. It was actually over 4.3% at one point. Oil, it says weaker rises. That's kind of a contradiction, isn't it? Let's get rid of you. Thank you very much. So oil is starting to get near $80. I told you when it was in the 60s, not a chance it would stay there, and it hasn't stayed there. It's been moving up. What to watch this week? Really slow news week. So we have the leading economic indicators coming out tomorrow. A little bit of Fed speak, minutes of the Fed's January FOMC. That could be a potential market mover. We'll have to keep an eye on that. Thursday, as always, the initial jobless claims come out. Then we get the manufacturing and services PMI number, kind of a state of the economy, existing home sales, more Fed speak, and then nothing on Friday. So you kind of get to take a break Monday, today, and Friday, and all the news is Tuesday, Wednesday, Thursday. Last week's heat map, Alphabet took a hit. Amazon took a hit. Look at the Magnificent Seven, with the exception, of course, of NVIDIA. You just can't kill that. Although there was a point in time it went from around 500 down into the low 400s, but since then it has come a screaming back. Energy was green. Eli Lilly, you have that obesity medication. They're doing fantastic. Tesla's trying to make a comeback. Wells Fargo had a good week. And year to date, some of these numbers have started to retreat a bit. Look at Apple. So for the last 12 months, it's only up 17.37%. But there's been a whole bunch of huge winners. Microsoft up 50, NVIDIA 218%, Broadcom 104, Alphabet 45, Amazon 67. Look at Tesla. For the last 12 months, it's actually down 6%. Meta 167. Plenty of opportunity out there if you know how to pick them. PPI comes in hot. You know what they say, some like it hot, but not the stock market. Went from a negative number to a positive number. Didn't help us. Home builders enjoying an uptick in traffic and in sales. So home builder sentiment is up, and the Fed probabilities. So now there is a 64% chance no rate cut in May. I remember when there was almost 100% chance of a rate cut for March. That's pretty much off the table. There's now about a 70% rate chance in June. That's kind of been the number I've been, or the month I've been honing in on. And if not June, it ought to happen in July. One of those 2 months. Fed doesn't want to cut prematurely and spark another round of inflation. So they're trying to, walk that tight wire. 1 year returns by sector, communication up almost 50%, same with technology. Discretionary 23%, industrials has been making a charge. Ditto with healthcare and financials. Materials, staples, energy, not doing a whole heck of a lot. Same with REITs, and utilities are down about 10% year over year. Take a look at the charts, see what's going on out there. Like I said, markets closed today. Well, we'll look at a 6-month chart on the S&P 500 and everything looks great. If we want to do a lower trend line, looks like that just raging up well above our 50-day moving average, and the 50-day moving average continues to be sloping upwards. So everything right now is bullish. Doesn't mean we're not going to have occasional pullbacks or down days, but it'll be interesting to see if this is going to mark a double top right here. See that? So we'll see what this coming week brings. How about the Qs? Same kind of a chart. More volatility in it, as you can see. And again, a potential for a double top. But 50 days moving up, Qs are above 50-day moving average. And IWM, that these are small caps, have really been the laggard. That is one messy looking chart. Look at it. It's all over the place. 50-day has been holding, so that's a good sign. So the 50-day has been established as a level of support. But the Russell 2000 is considered a proxy for the U.S. economy. You also need to know with the Russell, 30 to 40% of those stocks, those companies lose money. So it's a basket of 2,000 stocks, but not all of them are stellar. So there you have it. There's your market update. Enjoy your President's Day. Day off for most of you. Fantastic. Enjoy, and I'll see you again next week. All right. Bye for now.